Welcome to the CryptoWise channel. My name is Dave. This is going to be a Bitcoin update where people are starting to get exceptionally bullish and I am a bear still. And I'm going to go over the details as to why that still is. Short term, potentially slightly bullish, but macro still bearish. If you're new to the channel, we focus on macro technical analysis and facts in the charts so we can have clarity and ease of decision making in the crypto market, laying out the highest probabilities based on charts, patterns, confluence, and indicators. No news, no hype, no narrative, just cool, calm, and focused. Let's dive into it. Right, so we have this here. So what's happening now is we're pushing up into the downtrend line here that we've had. It's our weekly downtrend, and we may be breaking out of here, and I'm going to go over a couple scenarios of what I think is likely to happen. And the macro is still very bearish at this point. We're up against a lot of resistance, and this 78K so far is acting pretty strong resistance. Now I think there's a likelihood that we could still push up here a little bit higher, and then the likeliness is still that we roll over to the downside and see some lower prices. This is still the highest probability. So I'm going to go over why that is now. Let's get rid of the RSI. We don't need that. So a couple factors, just timing wise, historically, and the depth of the bear market we haven't seen those two things happen. I'm not going to go over to a whole thing about that, but just a couple reminders. The depths of the bear market and the structure of what happens have been historically very similar. 1 year down, 3 years up in a bull market, 1 year down in a bear market, 3 years up in a bull market, 1 year down in a bear market, 3 years up in a bull market. It's happened once, twice, 3 times, and we're in our 4th one right now that happens to be exactly the same. A lot of people, they drive a narrative that, oh, this time it's different, but, human behavior, humans don't change very much. They tend to repeat the same patterns over and over again because people are very emotional around money, and it's a pattern that repeats and we can see it. So if you can pull yourself away from your emotions and look at this from a logical standpoint, patterns are just repetitive. The highest probability is this pattern repeats again. So we have an 87% down in this bear market, right? That was in 2013. The 2017 bear market, we had an 84% down. The 2021 bear market, we had almost 78% down. And so far, we have not seen anything remotely close to that, because so far we have 53. Yes, the bear markets have been lesser as it's been going on, but here's how we can calculate this. The first two, the distance was only a few percent difference, let's say 2 to 3% higher. Between this one and this one was less than 10%. Was that 80? Let's call it 88. So 84 to 80. 84 to 78. That's what, 6%? So 6% less. If we were to do 10% less between the prior one to this one now, that would put us at 67. And that ratio is being conservative, because we're giving it more of an increase, less of a drop between the other three. Do you know what I mean? Sorry if my lingo is not making sense there, but like 67%, that gives us a target of 41,000. Totally doable, totally makes sense. Could we have bottomed here? It's possible, but not as likely. So the other thing is timing of these bear markets have all been within a specific time frame, right? From this peak high in 2013 to the bear market low, we had 406 days. From this peak high in 2017 to the bear market low, we had 364 days. From this peak high here in 2021 to the bear market low, we had 364 days. All averaging at the minimum 364 days, which is about a year, only off by 1 day. And we have not seen that type of timing yet. 365 days would put us in this, in between these two timing lines that I have here, these vertical ones. It would put us in there. Now it could be a little longer because it's between 364 and 406. So maybe it's a little longer, but the average is going to be, the minimum average is going to be 364. The average is probably somewhere between 380, I think. Maybe maybe around 380 or something like that. That's kind of why I have this box here, the timing, right? So those are just two things. I don't want to go over too much more than that in terms of why it's still pointing down. History often repeats. Plus the fact that we had a beautiful 5-wave move up usually follows a 3-wave move down. So one last thing I can share is that we usually have these 3-wave move down in a bear market, 3-wave move down in a bear market, and 3-wave move down in a bear market. We haven't seen that play out, and usually the third leg down is the more aggressive one. So yeah, it does kind of look like a 3-wave move, but it was a 3-wave move in a single wave is what it looks like to me. So we could easily have a slightly higher move here that would establish the second wave, and then we move down in a 3-wave move that would make a larger 3-wave move. You see what I mean? 3-wave moves are often just corrective structure. So it would make a lot of sense that if we do see some more up here, that it ends up being a bull trap, and then we roll over into a larger move down, which has happened before. This is a perfect example here where we actually broke out of the weekly downtrend, right? So we may be just repeating something very similar to the 2013 bear market, where we actually had a weekly downtrend break, right? Rejection, rejection, rejection. We make a W, we break out temporarily, and then we roll over into another 3-wave move down, which creates this larger 3-wave move, which is a corrective move to the downside. So these are typically how price moves. Very, very common to see pricing structure like this. So now, what is likely to happen here is this CME gap gets filled. So I'm going to open that up right now and show you what is going on. Historically, what happened with CME gaps. So I have two scenarios that I'm tracking right now that is very possible that we see. I'll just clean this up here. And I'm going to leave that there. I don't know why it's not lit up, but it's just my alert. This date has already passed. I don't know why. There we go. So, okay. So CME, Chicago Mercantile Exchange, they're closed on the weekends. So if the price moves on the actual chart, right, then it makes these gaps when it opens back up. Closes Friday and reopens on Sunday. While Bitcoin, the actual Bitcoin chart, does stay active. So you can see this gap. There is no gap here because it's on 24/7. This one has a gap because the price closed on Friday, and then Sunday when it opened, or in this case it says Monday, but it's actually Sunday around 4 p.m. Central Standard Time. Then it makes a gap. What happens is that when these gaps get created, the Bitcoin price continues to do its thing, but eventually comes back to that price to fill it. So we can see here that we had a weekend gap. We spent 2 to 3 months above it. We came back to fill it, right? Price came back to there, and then we went the other way, right? This was in a bull market, okay? Just keep in mind, this is a bull market. I'll show you another example. Over here, in an established bull market, price is increasing, right? We're making new higher highs. We're going higher. This is in the new year. But we made a nice CME gap here at a very specific level where the structure broke over here. It was a very significant level, 38. Yeah, I mean, it was a level here. We can see It's not perfectly in line, but it is definitely an area where price had resistance, and then when it broke above, it went higher. There's a wick into it there. There's a W that got rejected from it before it broke. So it's an area of significant structure in previous history. So like it was building up to it, and then it broke through. And then what happened was we spent some time above it, right? And then we had structure that was built above it. I think it was like here. And people were calling for lower prices because we broke below. But really what happened was this was a bear trap. So we had a significant pullback. We filled the gap and then went the other way. So that's 2 times where we're in a bull market, okay? And we make these price gaps as the price goes up, comes back to fill it, goes the same direction up, right, in the bull market. Okay, these are unestablished uptrends, okay? So understand, I'm talking about established trends, right? What we're looking at now and where we are now is we are an established downtrend. We're not in an uptrend, okay? And we can see that we have a gap here. It's a small one. And it's very possible that because we're in this established downtrend that we go up to fill it just before we go down. Much like what happened over here in 2024. We had a gap, fill, other way. And much like when we had it here, which took some months to fill, but either way, fill, go the other way. So this is a very likely scenario. These are how CME gaps tend to work. Usually they get filled either within a few days, or they get filled later on. I think it's something like a 93%. I'd have to look at the stats, but it's in the 90% probabilities that the gap gets filled. There's plenty of examples of smaller gaps getting filled, right? There's a gap there, got filled. I think there was some other gaps in here that got filled. There's a gap there that got filled to the upside. There's a gap here that got filled when we broke down, right? When we broke down, then we filled it. Filling is just basically the price coming back to where basically it closed. So, or where the Friday close was, or sometimes it's during the week, but the major gaps are formed over the weekends because the CME auction does close for an hour during the week on weekdays. So there could be small gaps also to look at. So this is a major reason why I believe that we could easily see this happen. Now the question is, like, how would that happen? Because it doesn't mean we're going to go up there now. I think short term we're bearish, and then it's likely that we see a little bit more of a pullback before we go up, and then we'd be getting that CME more closer to mid-May, establishing some structure. People are very bullish, and then it breaks down, and then we have the bear flag play out. That is a very likely scenario. I think this is possible. It'll just mimic the different style of gap fillings that we've had. The one here, when we were just back testing prior structure, and the one over here when we're also back testing prior structure. In this one, we actually broke a structure, right? These levels here that were support, we broke below it, but we actually ended up back testing this structure very slightly, and then up we went. So we could see something similar happen here, where the prior structure would be over here on the daily around 84, 85. So we could be going up to fill this gap. All right, I think the more likely scenario is that we see a pullback first, and then we have the full moon power that sends us into potentially all the way up to 85, filling the gap, and this would be a wick most likely, and then we see the price roll over way more aggressively like this. So minimum, I would say pullback, and then we see this CME filled, and we hold the bear flag trend channel. and then we roll over down, or we see a move up that brings us into, let me just clean that, or we see, so scenario one, I believe that either way we're going to see a pullback a little bit lower before we go up to fill the CME. This one here at 81K, we hold the trend channel and then we work our way down, break the bear flag, and down we go. Scenario one. Scenario two, I believe that we're going to see pull back again, but the up actually ends up shooting a little higher, and we get to that 85K, back testing this structure as resistance, and then we roll over into a larger move down. This would be the ultimate bear trap, because it would be a very clear break of the weekly downtrend. But this second scenario is also very likely because we have seen that before. Now, this is also that three-wave move I've been talking about. Remember I was talking about the larger three-wave move? So we have a three-wave move that also makes a three-wave move that is part of a larger three-wave move, right? So three-wave moves are corrective patterns, okay? So scenario two, where we go up to 85, is very likely, and I'll show you where that happened. Now, it happened in, I think, well, I'll show you in a moment. But why I think it's possible, because that's the 50% retracement. Well, yeah, I mean, okay, it's 87. So maybe we wick to 87, or we'll just get really close to that 0.5 retracement. It's the 50% retracement of this entire move down that we've had so far, okay? From 125K to, just make sure that's on logarithmic. Yeah, on log scale. Okay, so this would be the 50% retracement of this entire move that this entire downtrend that we've had so far. And that is very common to see a 50% retracement of a downward move before we go lower, right? It's the same thing to the upside. We see 50% retracements. To the upside, there's probably one here. Let's see, swing low to swing high. Look at that, very close, very, very close to the 0.5 retracement. So we could see something like this where it just almost gets the 0.5 retracement. That's this whole move here, this uptrend, 50% retracement, up we go, right? It probably happened several other times in different locations, but it has to be, you have to consider certain structures and trends in order to really get a 50% retracement. And there's probably one here, from the swing low to the swing high. So there's another example there on an uptrend, right? We're starting an uptrend here. This is the bear market low, right? W out, big move up, 50% retracement, up we go. Very, very common. Now, no, they don't just happen for the upside, but they also happen to the downside. So the thing is what happens is when people are so convinced that we're going up, and then when this crash happens, they're like, oh, we're going down, and really it's just doing a 50% retracement before, it's just a normal move before it goes up. So it'd be a very similar thing. If we break higher, everyone's going to get very exceptionally bullish, and really it's just a typical standard move that we see before we keep going to the downside. So going here, where I was showing you we broke the weekly downtrend. This is now we're in the daily time frame. This is the 2013 bear market. Remember the three-wave move. Again, this is the pattern that seems to be playing out so far. We have, right, a large three-wave move, and then a three-wave move correction that went to the 50% fib, right? 50% fib retracement. From this swing high to this swing low, we retrace 50%, right, in a three-wave move. Then we made a larger three-wave move in 3 waves. You see what I'm saying? So these three-wave moves, it's a common thing. And they were talking like 10 years ago here, more than 10 years ago. So if it could do this back then, it can do this again, right? So let me just zoom out a little bit. It seems a bit, I don't quite see the candles very well. So just want to show you again, three-wave move down, right? Three-wave move up into the 50% fib. that is part of a larger 3-wave move, and the third wave to the downside was also in 3 waves. 1, 2, 3. So that's what I'm expecting to see at this point, because it just looks like that's what's happening. And yeah, so that to me is what the likely scenario is. So 87K at the most. If we break 87K, I would be a little bit concerned that the bear market, well, I would be way more convinced that the bear market is coming to an end. So that's one thing that's important. I do believe that this move up could be very short-lived. As we can see the weekly candle. It's a bullish hammer candle. That was the gap fill, remember? This weekly candle also had a large wick. And this 50% retracement was also a large wick, right? So the gap fills, the 50% retracements, they seem to be very snappy. So we could very well see a weekly candle that has a large wick, very similar to this one here, but going the other way. So the reason I say this is because I did talk about in previous videos that if we close a 2-weekly candle above the 50 EMA, and that's still something I'm tracking, if we close it has to be a 2-weekly candle. So this one's closing in 6 days. It has to be a 2-weekly candle. If we close a 2-weekly candle above the 50 EMA, then I would be more convinced that the bear market is done. The likelihood of that is probably pretty low. There is a scenario where we don't make it to the 50% fib and we stay within the trend channel. We close this week here, next 2-weekly candle comes up just to fill this gap. We tag the 50 EMA and then we roll over into a larger move down, and that could be still the larger 3-wave move. It'd just be a shallower one. If the second scenario plays out where we go higher into the 50% fib, then I would most likely think that this second 2-weekly candle that would close in May 10th, this one here that would open here in 6 days, would probably show up as a large wick and close somewhere down here. So maybe we open down here and we close somewhere lower, like in here perhaps. It would be below the 50 EMA. So it would be a tag of the 50, the candle closes below the 50 EMA, and then that would be a strong rejection signal, and then we go down. So in the event that the 2-weekly candle closes above the 50 EMA, it would have to be within context of understanding the dynamic of what's currently happening at that moment. There are some exceptions to candles closing directly on a 50 EMA or on an EMA, and it still be a valid back test, right? Or back test either to the upside or the downside. We can see here that for this example, we got supported. We had multiple wicks below the 50 EMA once, twice, 3 times, right? And we got rejected, and then finally we broke through, right, to the downside. We could have the inverse happen where we're just back testing and we get a large wick to the upside, the candle closes below, right? So that's a perfect example here that what can happen right there, right? Large wick, closes above, and it still ends up going up. I mean, yeah, we broke below, but we're in a bear market, so it just kind of makes sense. All right, so that's kind of covering all of that. And yeah, we also have, the reason why I think we're going up here is we have that CME from Friday, which was at 77,200. So if I look over here on the 1 hour, there's a gap right here from the Friday close, which looks like we're going to go fill it today or tomorrow, but there is another one here. Yeah. I think that this move that we've had here, based off a few other factors, this whole uptrend needs a bit of a pullback before we go up. I do think that the full moon energy would likely be in play in order for us to push higher. Full moons are often energy that pushes the price higher, so that's something to factor in. All right, guys, be sure to like, subscribe. If you enjoy the content, share it with your friends. I do appreciate comments, and yeah, let me know if this was helpful. Yeah, if you guys want to learn, feel free to reach out. I do offer some one-on-one support, and also you can start your own TradingView journey. I have a link in the description below. You can check that out and start tracking things like I do on here, so you can get familiar with how to make your own assessments, not get caught up in all the BS and all the hype and all that stuff. So yeah, all right, I'll see you in the next video. Peace.